Hi, I'm Jim. I've been examining the recent tariffs and their impact, and I'd like to share some of my findings. It seems that it might be more appropriate to view Canada as engaging in competition, rather than collaboration, with a significant rival. This slide presents an overview of the total exports exchanged between the US and Canada. Canada exported goods worth $439 billion, while importing $353 billion from the US. It's noteworthy that fuels, oils, and distilled products account for a substantial $100 billion gap, which is primarily due to the US's supply shortage in this area. Taking this into account, the trade balance between the two nations can be considered effectively even, with the difference existing in an area that benefits the US economy by providing affordable oil. This spreadsheet illustrates three scenarios utilizing the existing exchange rate. The first scenario, labeled current, represents the situation with no tariffs imposed. The second scenario, non-compete, incorporates tariffs under the assumption that the increased costs can be passed on to the consumers. The third scenario, competitive market, considers a situation where tariffs are in place, but the landed price must remain unchanged to maintain competitiveness and avoid losing business, meaning that tariffs cannot be passed on to consumers. The analysis indicates that, as a result of these scenarios, profits may drop billions, taking into account the varying ability of different products to absorb the tariffs without significant market repercussions. Due to the potential loss of free trade access to the US market, Canadian companies may face reduced investment, possibly leading to a weakened Canadian dollar, reminiscent of the 55-cent exchange rate seen in the 1990s. This slide outlines three possible scenarios: the current scenario without tariffs, the non-compete scenario with tariffs but no competition, and the complete scenario that accounts for competitive factors. According to the analysis, both the current and non-compete scenarios yield significantly higher profits, while compete with tariff maintains the profits calculated in the previous slide based on a 1.45 exchange rate. Based on the available data, it's estimated that the impact of a lower dollar on $512 billion import from the US on Canadian inflation would be approximately $128 billion. If Canada were to impose a similar tariff on all its imports, it could lead to a further $128 billion hit to the economy. Then a further $12.8 billion in GST will be collected. However, these estimations are subject to change depending on various economic factors and fluctuations in the exchange rate. It's crucial to consider the broader implications of such tariffs on trade relationships, consumer prices, and overall economic stability. The potential consequences we're discussing are quite significant. Company profits and tax revenues could decrease substantially, while inflation continues to rise. Combined with the increased spending on defense and border security, the projected $61 billion deficit for 2023 may seem relatively minor in comparison. Furthermore, adding this to our existing $1.5 trillion US dollar debt raises concerns about the long-term financial burden that future generations may inherit. Is this a plan from our competitor for an economic war and takeover? This data offers a valuable reference by displaying the taxes collected by the Canadian government. Upon analysis, one can observe that tax collection and inflation share a degree of correlation. It's essential to factor in this relationship when considering potential impacts on the economy, such as the inflationary effects of tariffs or the resulting changes in tax revenues. Workforce for manufacturing. The combination of low unemployment and the deportation of undocumented immigrants can create a significant labor shortage in the manufacturing sector. This shortage can lead to increased competition for workers, driving up wages and, consequently, production costs. These higher costs can then be passed on to consumers, contributing to inflation. Moreover, the deportation of undocumented immigrants can have broader economic impacts. Research indicates that deportations can hurt the U.S. labor market and lead to worse labor market outcomes for U.S.-born workers. This is because undocumented immigrants often fill essential roles in various industries, including manufacturing, agriculture, and services. Their removal can disrupt these sectors, leading to production delays and increased costs.